Ladies and gentlemen, what is going on? It is your man Z Moose coming at you live from the Moose Den. Tonight we're going to be going over part 4 of the TMO Trading Steps Series. Part 4 consists of pinpointing the entry, planning the exit, setting an OCO, and adjusting your stop and price target along the way. Let's get started. Pinpointing the entry is something that I enjoy talking about because there are many different ways to pinpoint a stock entry. You're buying the dip, you're buying the breakout, you're buying at support, or the opposite. You're shorting the rip, you're shorting the breakdown, or you're shorting at resistance. Buying or shorting at important simple moving averages, the 50-day and the 200-day, is another way that you can pinpoint an entry, but sometimes that fluctuates, and we'll talk about that a little later. Another way that I like to kind of use something that I like to use for a second opinion when I'm pinpointing the entry is using technical indicators to assist your entry timing. And it's, as I said, I use it for a second opinion. When you're planning the exit, I've found that taking more than a 10% loss in a position is ridiculous. Unless you get caught in some kind of news-oriented issue that appears during pre-market or after hours. As a trader, 10% losses should not happen. They just shouldn't. You should be able to cut your losses before a 10% loss even occurs. And we'll get more into that for trading purposes when we start using an example to visualize this. Because of this, my stop-loss exits are between 3 to 5% for short-term trades and 5 to 10% for long-term trades. Similar to planning the entry, when your position is positive by a certain amount, you can always use technical indicators to help you make a decision to back out of the position and take that gain that you currently have built up. So before we get into anything else, let's take McMoran Exploration, ticker symbol MMR, as an example. In this case, you're either going to be buying the breakout or you're going to be shorting the rip and shorting at resistance. So if we take a look at this chart, it is pretty interesting. This is a pretty strong downtrend that we've seen over a long period of time since the early portion of March 2010. And you also have this area that we've broken out of on Friday, 1254, and we closed above it on mediocre volume accumulation. So our current setup right here, if we're defining our parameters and we're looking for an area to enter, let's go to our analysis and let's look at the long side first. If we're going to take a $500 position, we're going to buy about 40 shares of MMR, and we're taking it at 1270. Okay, so our long target would be 10%, a positive 10%, and it would be at a stock price of $14. Our stop loss would take place at $12 a share, and that would be a 5% loss. And that's all we're going to max out here. This is going to be a short-term trade, and that's what we're looking at. If on the short side, if you think that it's going to hold that that descending price trend line, for the short side, our schematics and our parameters would change a little bit here. Our profit target would be at 1140, and our stop loss would be at $13, which is a 3% loss, and with that gain, it's about 10%. So as you can see, if we kind of flip back and forth between these particular parameters, the short side of the deal is a lot better if you have faith that that descending trend line is going to hold. So if we're going to look for an entry, we've hit 1270, not the best entry, but in this case, it almost looks like a trader, if they entered here, would be, for the most part, buying on the breakout. Some traders may be looking at this descending trend line and shorting it, and that may be proper, but in this case, if we do get a breakout, we could really run, and we could run to that 100-day simple moving average. So, in reality, there's real no risk-reward edge here. It's mostly off of a trader's opinion. The smarter trade would be to take that short, and if it doesn't work out, go long, and maybe even wait for some consolidation in between 13 and this 1255 price support here that we broke above on Friday. If we go back to the PowerPoint here real quick, setting an OCO order is one thing that I think is very helpful when you're not around for an entire day. OCO is an acronym for Order Cancel Order. I use OCO orders if I walk away from my computer for an extended amount of time, as I said. If I know I won't be present for the open or the close, I also use OCO orders just to protect myself, because the open and the close are the two most volatile times of the market. I mean, anybody can honestly say that those are the two most volatile times, because on the open you have order inflow from the people that didn't get filled on the day before, and during the close you have as many people trying to catch that bid before the next day. OCO orders allow you to have flexibility when it comes to constantly monitoring your position. If you have your parameters set, in this case with MMR long, you have your $12 5% stop loss, and you have your $14 10% gain off the initial investment. Your parameters are set. Your risk reward is measured. In this case, we'll kind of let that go, but your risk reward is measured. You can set an OCO and let the position go until your profit target is hit. Just to visualize that a little bit, we can go to the trade area here in Thinkorswim. If I were going to go long the OCO order, I bought at 1270 and then I put this in. The limit would be at 14. The stop would be at 12. We take our 10% gain, and we'd also have our $12 stop. Whichever one gets filled first, the other one is canceled. For the short side, we have our 1140, our 10% gain on the position, our 1140 limit, and our buyback at $13 for our 3% stop loss. So, let's wrap it up here. Stop and price target adjustment. For stocks, I make sure that once I hit a certain profit target, I protect my profit with a stop. My initial profit target is a 10% gain off of an investment. So with the short side, it would be 14. With the short side, it would be 1140. With the long side, it would be 14. In the case of our MMR example, if the target is hit, I make sure my stop is placed at 8% from my initial investment, while raising my profit target another 5% to a 15% gain. So if we go to visualize that, 14 is hit. We take our 8%. We take our stop from down here on the long side. Let's say we take our stop from $12. When 14% is hit, we take our stop from $12 and we move it to $13.70. So that way, if it pulls back, we have an 8% locked-in gain. If it continues going and let's say it breaks out, our 15% then is covered. I'll continue to use this strategy throughout the entire trade, and I like to refer to this strategy as the stair-step trading method. You're going along a stair-step, and you're continuing to lock in profits along the way with somewhat of a manual trailing stop. Ladies and gentlemen, take that trade and make some money. Class is dismissed. You have been through the TMO Trading Steps Part 1, 2, 3, and 4. Use it to your advantage, and good luck with your trading. Have a great evening, and have a phenomenal weekend.